All right. We're live, huh? We're live right now. I'm supposed to do my normal shtick, right? Okay. All right. We're back for another Friday Financial Wrap-Up with Mr. Michael Zuber. How are you, Michael?
I'm doing well, man. We're out of practice. I take a week off and all hell breaks loose.
This is for September the 5th, 2025. Let's get right into it. Jobs. You said it all along. You're the only guy in real estate news that has always said jobs, jobs, jobs. Jobs week. What happened this week?
Yeah, I want to set this up because I think this is going to go down as a inflection point in our economy and frankly in housing.
Yep.
And I really mean that. I think this week will prove to be an inflection point for the mortgage business, for real estate agents, for investors. So again, going into this meeting, and actually starting 6 weeks ago, I said that the Fed was going to be cutting 50 basis points between X day and the September meeting. And the September meeting is 2 weeks away. Why did I say that? I believed that two things happened that were important, critical, and most people missed. First, obviously, those horrible jobs revisions. Everybody talked about them, but nobody understood the importance. And the importance was the economy was frankly contracting. And, you know, if you study history as long as I have, nearly 30 years, the job market doesn't take the stairs down, it takes the elevator. So once it loses gravity, it's game over. And that's what I saw 6 weeks ago. And then second, what we had Jerome Powell and many of the Fed presidents 6 weeks ago clearly, without saying it, but saying it, if you know what I mean, jobs over inflation. Because again, they stopped talking about tariffs ad nauseum. They started talking about jobs and or what they might call the labor market. So today has always been important. I had been pointing it today for at least 4 weeks, saying, and again, I want you all to remember, I was calling for a 50 basis point cut when the odds were zero.
Yeah.
And I'm like, it's coming and it's going to happen on this date. And then when we step back and look at mortgage and real estate, we'll talk about this after. So let's talk jobs. Every month, this month is no different. Just like inflation, we get 3 readings. So jobs this week, we get 2 inflation prints next week, which we'll talk about at the end of the show. But the first one we get is called the JOLTS report. Most interesting to me is just the job openings. It also has the quit rate and some other stuff in it, but it's job openings. And I don't have the numbers in front of me, but we were expecting, I think, 7.4 and we got 7.18. But so what? What does that mean? Well, it means a couple of things. First, horrible miss to the downside. Second, it was the lowest reading in the last 20 or 24 months. But most importantly, and again, remember, point one from earlier is the job market's crashing, right? It's the economy is not doing well. We now have, for the first time since the pandemic, more unemployed Americans than job openings. Let that sink in.
Yeah.
And, again, if you don't recall, for a long time, we had 1.5, 1.6, 1.7 job openings for every unemployed American. So basically, if you were unemployed, you were, lazy or not looking or, whatever, in between jobs. That's not the case anymore. And when you have more unemployed than job openings, you are going to see continuing claims scream higher. So this is what I saw coming. And in the JOLTS report, kind of feels like we're there. It's going to get worse from here. Okay, great. That's the first of 3. And also, let's not forget, we've been talking about the JOLTS report on this channel for 7 years now. So you can go back and look at it, do a search, all of this stuff, because it happens every month like clockwork. And really, the beauty of understanding the labor market is by watching it monthly. So number 2 is the ADP report, private payrolls. It was expected to come in at 75,000 or 74, depending on who you looked at. It actually came in at 54. It was also one of the lowest readings in the last several years. It was also a significant miss to the downside. And again, not good. And then the big boy this morning. Yeah. It was expected to come in at 75. It came in at 22. The unemployment rate is now up to 4.3. It is the highest reading since 2021.
Wow.
But the most, and again, 2022 is, or 22,000 is bad, but it's not the worst number. Folks, we have revised June to negative 13,000.
Wow.
The American economy lost 13,000 jobs in June. And if you don't remember, the first report of June was 135,000 to the positive. So again, the Fed gets this 135,000 number, thinks everything's glory. Fast forward 2 months, it's now negative 13,000. This is what I saw. This is why I called 50. And all three numbers bad. And,
Wow.
Not good.
You've got the receipts. You're the guy that's been talking about jobs. And not only that, you were saying, I feel like from you, the mantra this whole entire year has always been jobs over inflation. You've been talking, like I hear that now on CNBC a little bit here. They're talking about it now. You were talking about it last year and all year long. And not only that, but also the correction that you said, again, 4 to 6 weeks ago, you said, hey, I bet you personally in the beginning of the year, you said no cuts all year. And then the last 4 to 6 weeks, you were saying, hey,
50. Yeah.
We're going to see 50 basis points. So we're 2 weeks away. Let's talk about that. So let's talk about the odds of a cut now. What do you see?
So again, I haven't changed my opinion. Again, I'm going 50 and I'll just die on the hill. If I'm wrong, I'm wrong. I love being wrong because it just gives me the opportunity to learn. But again, going like last night, the odds of a 50 basis point cut were 0.
Yep.
0. I checked 45 minutes ago. I haven't checked in the last 45 minutes. Now the odds of a 50 are up to 12%.
Right. And so what was the 25 basis point?
What was it?
What
so
was it?
As of yesterday, these are going to go from memory. I think it was 97% chance of a quarter and 3% chance of 0, something like that.
Yep.
Now it's 88% chance of a quarter and 12 of 50. So 0 is no longer an option.
You're on it, man. I got to say that we said this pre-roll. For those of you like Angel, I know Angel, you're watching right now, listening, watching. I know for the hardcore folks, none of this is a surprise because you've been talking about this for weeks and weeks. Yeah, man. Wow. Okay. So we'll break it down. We'll talk about opportunity. Let's keep going with the show.
Just so you know, the odds are now 14%. So they've gone up 2% in the last 45 minutes. Just cause. I'm just saying.
At the end of the day, we'll be checking our ticker there. So
exactly.
But let's keep going. So let's talk about the 10-year. So how did the 10-year? Explain what the 10-year is. Why is it important, and what happened?
Yeah. So, folks on this channel should hopefully know this, but for new followers, and thank you if you are new, the Fed controls the overnight rate, which influences the rates all the way out to what's called the 2-year. The 10-year note is really controlled by the bond market, and 10-year is what influences mortgage rates. So if you step in a time machine and you go back a year, the Fed cut 100 basis points, but mortgage rates went up 80 basis points or 88 basis points or whatever. So, it kind of surprised everyone, but not us. But that's what happened. So just because the Fed now is going to cut a quarter or maybe 50, like I say, does not mean mortgage rates go down. You should be following the 10-year. And all I can tell you is the 10-year broke. The 10-year broke. It was staying pretty steady at 4.3.
Yeah.
It's now under 4.1. I haven't again checked in the last half hour. It was at 4.08 last time I checked, and might be lower now. I don't know. But that will drive mortgage rates lower. So this is a clear sign that people think the economy is slowing in a pretty big way. Yeah. Right. To see the 10-year break that big this year, or this week, sorry, is noticeable. It's given up all the support lines. I think there was a support line like at 4.18, and it just cratered through it this morning. So yeah, that's where we are with the 10-year. So expect mortgage rates to go down. Mortgage rates, last I checked yesterday, I think were 6.4 4.4. They're
Yeah.
going to be lower today. They're going
Yeah.
to be a lot lower today.
Yeah. It's interesting because you were traveling last week,
Mm-hmm.
and I only based on your work and what we do together and being able to surf what I call surf your wave.
Mm-hmm.
I feel pretty good that last week I called. I said, "Hey, we're down 50 basis points on mortgage rates. You know, the 30-year was over 7 beginning of the year, and last week we were at, you know, plus or minus like 6.55, somewhere in there. Obviously, we're breaking that 6.5 mark, and it looks as though it's going to be trending down then." Yeah.
Yeah, no question.
Okay. Let's talk about, mortgage rates. How do you see this playing out based on the jobs? This is a curveball.
Sure.
So based on the jobs, based on where we're at with the 10-year, how do you see, like, is this a trend that we can count on into September? Or is this this a micro trend of just this week?
That's a very cool question. And this kind of ties into inflation. So we do get we get 2 inflation prints next week, PPI and CPI.
Okay.
The only thing that could stop this clear momentum is a nasty inflation print.
Okay.
And I just don't see that coming. But with that one caveat, and let's what would nasty be? So I don't know what the forecast is. That will be my weekend reading. I'm going to guess CPI headline and CPI core are probably going to be estimated to be between, I don't know, 2.7 and 3.
Okay.
That'll probably be the estimates. I'm just guessing.
Yep.
Like a nasty print would be like 3.2 or 3.3. Right. So a significant, like, just a chasm of a leap.
Yeah.
I don't see that coming. I just don't see that in the underlying numbers. But with that one caveat, there's nothing that stops this train.
Okay.
Right. There's one thing that you could, if you wanted to look for a curveball, to your point, it would be just a nasty, shocking CPI reading. I don't see it, but that one caveat.
It feels like, too, the CPI, I mean, 2.7, 2.8, 2.8 kind of, in my mind, feels like that's been.
Yeah. It's not going to be 2.8's not a problem. I mean, it's even 3 is not a problem because, again, we've kind of been here before. And again, if you study inflation like we do on this channel, we have a very positive base effect coming. The next 4 months are big numbers. So even though this is the last month of a small base effect, the next several months, inflation will look like it's going sideways. And the Fed knows that. So there you go.
It's interesting, too, that, the headlines, if we look back, go into March, April, May, June, tariffs, all of a sudden now it's jobs.
Yep.
Yeah. Which you've been saying, jobs over inflation this whole entire time. So let's keep going. Let's talk about lenders getting aggressive. Talk about margin compression. What's going on with lenders?
Yeah. If you've been paying attention the last 2 weeks, and this is real subtle stuff. So if you didn't see it coming, not a problem. But the thing that I was noticing while I was out, enjoying Alaska with some friends, and this week is the 10-year was essentially going sideways, but mortgage rates were getting better. That, for a long time, that didn't happen. And I'm talking years. But what we're seeing now is margin compression. Now, again, we're still historically wide. Right, we got as wide as 310 or 312 basis points. The historical average is 175 basis points, and we are currently sitting at about 240 basis points. But what I believe is happening is lenders are starting to get aggressive. They've been fat and happy for a long time with a robust margin or spread. Mm-hmm. And now, given the lack of activity in the housing market and the lack of business, they're starting to eat margin, i.e. compress, and we're seeing better mortgage rates, even though the 10-year went nowhere.
Right.
That's how we got below 6.5 before this week jobs report. Like Monday morning, we were 6.49. We're going to be significantly below that at the end of the week because of the weak jobs market. Mm-hmm. But what we're having right now, and this is why I say this week's going to be important for lenders in housing and all of that, is we now have lenders getting aggressive. Right. We're going to talk about something Convoy just told me about yesterday that is just freaking crazy to me.
Yeah.
In a minute. But this is just showing me that the market is behaving like I've learned. When business falls, people get aggressive, and lenders are getting aggressive. And again, the thing for me to understand is once this starts, then the competitive juice is going, right? There's always a first mover. There's always one guy that does it first. He socks up all of the demand, and then others follow. So this is just classic capitalism, in my opinion. And we're going to see lenders get aggressive, right? If you have a refi out there, or if you have some equity you want to go tap, it's coming. It's coming.
It's coming. It's coming, folks. Everything Michael's been talking about, everything you've been wishing for, it's all coming. Those rates are they are softening. They're coming down. Talk about, so just what has traditionally been the margin and the mortgage, so talk about the 10-year. The 10-year is at 4 point.
For easy math, what you can do is you can take, let's say the 10-year today is at 4, just for really, really easy math. So it's 4.000 or 400. What you would do, again, for easiest math, is just add 180. So 4.0 becomes 5.8, right? That's the historical spread. Now, in fairness, it's 1.77, but who cares? And today we're at like 240. So again, that's 4 plus 2.4. So that's 6.4. So today we're at 6.4, where historically we would be at 5.8. So that's about 50 or 60 basis points of margin compression, even if the 10-year doesn't fall. And as we just talked about, the 10-year is down like 20 basis points in 48 hours. So rates are going down.
I hope people took note on that. That's a really big distinction, understanding margin compression. You've been talking about it. What does it mean? Thank you for breaking it down. Let's talk about Convoy Home Loans. What's going on? Those guys are awesome. Yeah. Dustin, right?
Yeah, Dustin and Jonathan. Yeah. So
Jonathan, talk about it.
So I'm lucky enough to talk with them once a week. Again, and the reason I like talking to them is if you guys don't know, Jonathan's the CEO and Dustin's the other way around. Dustin's the CEO and Jonathan's the COO. And because if you follow them or reach out to them from one rental at a time, you deal with those two guys instead of being in the queue. So hopefully you see that as value. But anyways, they're always talking to Wall Street. They're likely to be, they're like a top 5 or top 6 mortgage broker in the country. They're monsters, right? Yeah. And I talked to the 2 top guys, and just out of nowhere yesterday, Dustin and I were riffing, and he said his rate sheet for the first time in years had a 4.99 as something he could quote. Because again, all these lenders, they get rate sheets, right? And they changed every day, sometimes multiple times a day. Yep. So he told me on Wednesday, for the first time, his rate sheet had 4.99, and I'm like, what? What are you talking about? He goes, yeah, one lender, right? One fund has allowed, and this is what I'm talking about, lenders getting aggressive. Remember, there's always a first mover. So this is not apparently a rate that lots of people can quote yet. There's always a first mover, and apparently Convoy has access to the first mover in this example. And 4.99. Now I'm doing this from memory. Dustin did give me permission to give his phone number, so I'll do that in a minute, because this ain't a Zuber thing. This is Zuber hearing it and sharing it with the world. Owner occupied, purchase, 20% down. I think he said 740 credit and above, and roughly 1 point, which in today's market, get the seller to pay the point.
Yeah.
All right. So that's conventional, right? So again, I was shocked. I've always said, if we go below 5, watch the F out. Yeah. Well, apparently there's at least one fund. And again, this could change tomorrow, right? It could change today. The fund could be done. Who knows? But apparently if you reach out to Convoy, and specifically Dustin, and again, I'll give his phone number right now. You should call Dustin, tell him you came from one rental at a time. Tell him you heard about this 4.99. Again, owner rock, 20% down, 1.740 credit. There may be some other things. I don't know. Call him. I'm not that guy. So here's Dustin's cell number. 323-476-0156. Call, text, do whatever you can if you are in the market to get that money sub 5. Now, if you are an investor, On the side, he's like, well, if you're an investor, you can't get that. Because again, I've said it 3 times now, ORaaT.
Right.
You can get something around 5.3 with this one fund. 5.3.
Wow.
What the hell? It's
Wild.
nuts.
Wild.
So again, tie this all together with what you asked earlier. Spreads are coming in.
Yep.
Lenders are getting aggressive. Now we have the 10-year falling. Guess where this goes?
Yeah. You called it, man. You called it. And like a light switch, I've got properties that were dead all summer. And like a light switch, offers, multiple offers, everything, dude, you're so spot on. I love it. Let's keep going. Show notes, Lennar, the home builder. Talk about what they're up to. A lot going on. We talk about Lennar quite a bit here. Talk about
Lennar. Lennar, the Lennar, again, if you read the earnings statements, which I usually do, I think it was 2 quarters ago, their CEO made a declaration, pace over profit.
Yep.
Which translate to is we're going to build a shit ton of homes and hope people show up.
Yep.
Well, what happened over the last several weeks is they now realize that buyers didn't show up everywhere. They have a lot of finished goods. In fact, the country has more finished new homes than we've had since the great financial crisis. So not good. Builders sitting on inventory, not sold. Not good. Very recessionary, frankly. But again, what Lennar is now doing is they're actively marketing to real estate investors.
Yep.
Saying, come buy new construction. And, oh, by the way, we'll finance it for you, right?
Yep.
When I bought this Lennar home, which I'm currently sitting in, they were only financing ORaaT. They would not do investor loans. Now they will, right? Because they have a mortgage company. I mean, geez, what the heck, right? So they're now financing. So what we're seeing, and oh, by the way, one more piece that I got this from Resi Club and Lance Lambert. Again, if you take the time to read Lennar's financials, you will realize that their average reduction or cost that they're absorbing per home sale is 15%. It's like 15.8. So we'll round it to 15. So what I am doing, and I'm still actively having these conversations, and because I've had these conversations, other investors across the country are already doing this. We're being aggressive with Lennar, just like lenders, right? Again, Lennar has inventory, and I guarantee you this inventory will be soaked up in the next 3 to 5 months. It will be gone. It'll be vapor. You will have missed your opportunity again. And I'm writing disrespectful offers on new constructions. Dude, there's a very good chance that I either A, buy a Lennar home for cash and get something like a 30% discount, or B, I buy 3 units and get like a 20% discount and financed, right? I'm having these conversations right now, and I'm trying to get something stupid. So crazy deals. But this is not only happening in Vegas, right? Or Henderson. It's happening across the country. So if you are in a market where Lennar is building and they have inventory stacking, go Google, right, Lennar's investor site and see if you can't go steal a deal. I can tell you, I mean, you asked me, Zuber, if you had to do it again, what would you do? I'd have 40 brand new single family homes. Well, there's a good chance I might have 2 or 3 in the next, 8 or 10 weeks.
Love it, man. Love it. And Lennar, it's interesting. I was thinking too, the comment, Lennar, we talk about Lennar because they're progressive. They're very progressive. They're cutting edge.
They're first mover, right?
Yeah.
Lennar's going to blow these out, and then other builders, if they want, they'll do it too. Yeah.
Great job, Lennar, man. Great job, Lennar, being progressive. I love it. So next week, talk about next week. I think you got a surprise, maybe not a surprise. Some people know about it, but you're doing some really cool stuff in the community. Talk about next week.
Yeah, there's a couple things really around next week. Number one, it is inflation week. We did have that caveat out there earlier, right? So we'll be talking about that on the next week's weekly wrap up. But one of the things that you asked me to do, suggested, nudged, cajoled, whatever, was we should give some goodies away to folks who buy our Vegas tickets early.
Absolutely.
And you are absolutely right. So what's going to happen tomorrow? So tomorrow is Saturday. So Saturday morning, it is my intention to reach out to everybody via email who bought tickets to our Vegas event, which I think stands at 135 people. Okay. So all of you are going to get an email from me. And in that email, you're going to get 2 things. One, you're going to get a Zoom link to a conversation, just us. So again, usually I do them in school, which could be hundreds of people. We do them on YouTube, which could be thousands of people. We're going to do it for school. There's going to be a dozen people because again, I think it's 135 and I'm guessing 20 to 30 people show up.
Yep.
So very intimate, open to anything. And I'm going to do it in the evenings. I typically don't do anything in the evenings just because that's, my me time. But I wanted to do something special. So it'll probably be Wednesday or Thursday in the evening. I haven't, gotten the sign off from Olivia yet, which day, but you'll see a Zoom link for a call, a Zoom call, very private, very intimate, won't be recorded, won't be shared. It's just us as a thank you. So you can ask me anything, real estate, economy, health journey, whatever you want. And then second, in that email, you're going to get a link to my Teachable account, and you're going to get to select up to $150 in free goodies that you want. So all you have to do is reply to that email with what you want, and I will add it manually. I don't have a team, right? I don't have a bunch of VAs running around, which probably would make it more efficient. But I'll send the email out to 135 people. You all can reply with what you want, and I will add it manually and then confirm via email. The last thing is, if you want to get my big course, how to get started one rental at a time, which is $399, you can absolutely use the credit against that. We'll just work out a way to, pay the difference, and I want to do what's right for you and me, and all that good stuff. So that's all happening next week, Wednesday or Thursday. But I want to extend the offer, right? Because not everybody bought tickets. So for the month of September, we're going to do the same thing, except it will be $100 credit.
Okay.
So again, same deal. We'll have a phone call in October. I actually suspect the September purchases to be less, so I guess the call will be even more intimate. There's a chance it'll just be a couple of dozen folks.
Yep.
But yeah, we're gonna keep trying to sell this Vegas event out. We do got crazy people coming like Pace Morby and others, Jason Hartman and Sean and Sharon and just all these other amazing people. And you want to be in the room, and I want to give you $100 in teachable courses for buying early. So buy your tickets, buy your tickets, buy your tickets.
Did you buy your Vegas tickets yet, folks? Folks, get your tickets. This will sell out. I know I've said this. It will sell out. It will absolutely sell out. Jason Hartman, a legend. If you don't know, this is a guy that he's been doing education, high-level investor, turnkey investments, really big community, as well as, of course, Pace Morby. This event will sell out. Go to Eventbrite, look up One Rental at a Time. Get your tickets now. Get the free bonuses that Michael's offering. Also, too, the intimate, just the coaching. Get to be with you on a Zoom, ask you anything, buy box. Should I buy out of state? Should I buy local? What kind of financing? What should I be doing, Michael, to find deals? All of it. Talk about school community for a moment.
Yeah, so school still rocking and rolling. We have 460 some members. No, not tomorrow. Sunday morning, we're going to hear from somebody doing rent by room or co-living, as it's called. Somebody that will be speaking at the event in Vegas, Jared. And we're just going to keep bringing you value in there. There's 8 accountability groups, free education. The big thing I'm so proud of is the community is we're just all everyday wealth builders, like my hat says.
Yeah.
And it's the community that makes it so valuable. So very active forums, different accountability groups you want to go to. So join school. It's 67 pennies a day, $20 a month. If you don't like it, leave. Also, Mark, the financial firefighter, still has a few spots left if you kind of want to try and buy. If you use Mark's link, so reach out to Mark. He'll reimburse you for the first month. So no risk if you reach out to Mark, the financial firefighter. And it's a party, man. We're gonna be over 500 people very soon.
I love it, man. Michael, so many good things going on. Jobs over inflation, rates are coming down. You called it. We're probably going to see some delistings here in September. We'll talk about that next week.
There you go.
Anyway, Michael, thank you for all that you do. Have a great weekend.
All right, buddy. Take care. Thanks again.